Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest-growing regulated all-in-one trading and investing app. Whether you're looking to invest in U.S. stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the detail are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome to the Deep Dive. It is October 28th, 2025, and the digital asset space is definitely buzzing. There's this familiar tension. We seem to be sitting right on the edge of maybe a major market move, but it feels like, I don't know, the whole system is just holding its breath.
Yeah, that's a good way to put it, holding its breath.
So our mission today is really to figure out why. We want to try and pull apart this complex relationship between, the geopolitical waiting games, this huge institutional ambition we're seeing, and maybe even a philosophical challenge to decentralization itself.
That tension is really palpable, you're right. And the core issue is that anticipation. We're in this market context where the global crypto market cap is, nudging towards that $4 trillion mark again.
Right.
Bitcoin's pretty stable, around $114,000. But that pause, that temporary halt in really aggressive upward movement, it seems directly tied to the geopolitical stage.
U.S.-China stuff.
Exactly. The long-awaited agreement on tariffs, the framework around the TikTok deal, until there's some clarity there, the big money, the large capital pools, they're just staying cautious.
Okay, so let's unpack this volatility a bit more then, because if we look past those, high-level market cap numbers, the actual flow of money, capital in the last 24 hours, it tells a kind of contradictory story.
It really does.
Bitcoin ETFs saw some modest inflows. Nothing huge, maybe, $7.4 million? It suggests, okay, there's still some baseline institutional interest there.
But yeah, the Ethereum ETF data is the real flashpoint here. The outflows were, frankly, staggering.
Staggering how?
We're talking $126.3 million flowing out of Ethereum ETS. That results in a net total outflow for Ethereum of nearly $119 million.
Wow.
Yeah, that kind of massive flight from ETH, while Bitcoin is seeing inflows, however small, it kind of screams intentional activity, doesn't it?
It definitely raises eyebrows.
Yeah.
So why dump Ethereum right now? Is it just like a simple rotational risk-off thing, investors getting nervous before a big announcement?
Maybe partly.
Or is it more like your hypothesis, deliberate market manipulation?
I'm leaning towards the latter, and here's why. Tomorrow, the 29th, is the FOMC meeting.
Ah, okay. Powell speaks.
Right. And these key dates, when Jerome Powell is expected to talk, especially if the whisper is he might cut the interest rate again, these dates get targeted. It's historical.
Targeted by who? Whales?
Whales. Big
Yeah.
traders, yeah. We know they deliberately try to create artificial volatility right before these events. They want to capitalize on whatever momentum comes after the announcement.
Right.
So a sudden, huge, targeted outflow, like we saw from Ethereum, it looks like a perfect setup, a precursor to a volatility spike they can then exploit.
So it's less about, oh, I don't believe in Ethereum long-term and more about short-term tactics.
Exactly. It's short-term tactical positioning, especially knowing the wider market's attention is kind of fixed elsewhere, on the Fed, on geopolitics.
Okay. So if the volatility feels tactical, the confidence we're seeing elsewhere feels much more strategic. And that strategic confidence, it brings us right to this ideological battleground, this conflict that I think could really define the next decade of finance. You've got the core idea, the ethos of open decentralization, running headfirst into the demands of enterprise compliance. And nothing seems to represent that clash better than IBM's brand new, pretty major initiative, Digital Asset Haven.
Digital Asset Haven, yeah. It's IBM's big play, their definitive answer for regulated finance. And importantly, it's not built for you or me, the average person.
Oh.
It's a secure, scalable platform designed exclusively for banks, governments, these heavily regulated corporations. It promises to handle the whole digital asset lifecycle, custody, transactions, settlement.
All while ticking every compliance box.
Exactly. Total audit-ready compliance. That's the selling point.
And when you dig into the tech specs they're talking about, it's clear they're selling one primary thing: complete risk mitigation. They mentioned managing transactions across, 40 different blockchains?
40, yeah. And security reinforced by things like multi-party computation, MPC, and quantum-safe cryptography.
Okay, let's break that down. Why are those specific features so crucial for, say, a bank? MPC.
Well, MPC, multi-party computation, is vital because it lets sensitive data, like private keys, be used in calculations without actually revealing the key itself to any single party.
Ah, right. For internal controls.
Precisely. For governance, for redundancy, and quantum-safe cryptography. That's IBM basically signaling we're building for the long haul, protecting assets from theoretical future computing threats.
So they're not just selling a blockchain product, they're selling certifiable security. Peace of mind for institutions.
That's the package. Certifiable security.
Which brings us right back to that philosophical red line. Because for the audience listening, the real takeaway here isn't just the tech, it's the architecture. This whole thing is fundamentally permissioned.
It is. It's closed loop.
A walled garden.
Absolutely. It's a total rejection of the foundational pillars of Bitcoin and open protocols. When IBM talks about policy-driven governance and multi-party approvals.
I mean, access control. Centralized authority.
Explicitly. This is basically a private or consortium blockchain, probably leveraging things like Hyperledger Fabric, which IBM has a history with, just dressed up in digital asset language.
So while the fintech world might be hailing this as a massive win because, hey, it gives institutions the compliant rails they need,
right,
we also need to see the warning sign here.
It's a massive red flag from the perspective of those core principles. Open source, permissionless, censorship-resistant, borderless, neutral, publicly verifiable. Regulated finance is getting ready to adopt the asset class, sure, but they seem absolutely determined to refuse the decentralized, trustless philosophy behind it.
IBM is basically creating a parallel digital economy built entirely on control. And the money flows suggest institutions are lining up, ready to jump into that controlled environment.
Yeah, the capital movement backs that up.
Let's look at a couple of examples showing this rising institutional confidence. First up, the stablecoin giants.
Right, stablecoins. They're arguably the most critical bridge between the old financial world and the new one. And that partnership between Citigroup and Coinbase to, as they put it, polish stablecoin payments, that's huge.
What does polish mean in this context? Faster?
Yeah.
Cheaper?
Both. They're working to make processing funds between fiat and crypto much faster, much more efficient. Citi is basically positioning itself to handle tokenized dollar payments at scale. That's a huge implicit acceptance of the tech from the highest levels of Wall Street.
And it's not just experimenting, is it? Cities actually put a number on this. They're forecasting the size of the market.
They are, and it's a stunner. They predict the stablecoin market cap will balloon to $4 trillion by 2030.
$4 trillion from what, about $350 billion today?
Roughly, yeah. It's a gigantic leap. And when one of the world's biggest banks issues a forecast like that, it's not just a wild guess, it's a strategic roadmap.
It signals they believe the regulations will fall into place.
Exactly. That regulatory framework will align, and tokenized payments will become a core financial utility. And look, if Citi, JP Morgan, Bank of America, if they're all exploring similar paths, they're effectively confirming the need for systems like IBM's digital asset haven to manage that future $4 trillion market. They need the compliant infrastructure.
And not just the big banks either. Corporate treasuries are getting in on the action too. Look at BitPlanet, a publicly listed tech company in South Korea. They've just jumped into the deep end with a serious Bitcoin accumulation program.
Yeah, we saw their first regulated purchase just a couple of days ago, October 26th. They bought 93 Bitcoin, importantly, through a licensed domestic exchange.
So fully compliant.
Totally compliant. And this isn't just a one-off speculative trade. It's part of a formal corporate treasury strategy, backed by a $40 million fund, their stated ambition, to eventually accumulate 10,000 Bitcoin.
10,000 Bitcoin. That's mirroring the MicroStrategy playbook, basically.
It is. It shows that corporate financial planning, at least in parts of Asia, is evolving really quickly to embrace Bitcoin as a treasury asset. Global conviction is spreading.
But, and there's always a but, the risk is still tied back to that geopolitical instability we started with. Analysts are still warning, right? If those U.S.-China deals go sour.
Yeah, if they sour, that institutional confidence could fracture pretty quickly. And Bitcoin prices could drop back down substantially. Some are saying potentially revisiting that $74,000 range.
So that constant geopolitical overhang is like the fragile piece in this otherwise really bullish institutional narrative.
It's the irony, isn't it? Institutional confidence helps shield Bitcoin from, say, retail hike cycles, but it makes it much more exposed to central bank policy and these high-level state negotiations.
Okay, let's pivot slightly but connect the theme. This idea of massive, centralized, almost nation-state scale infrastructure spending. We see a parallel trend in the AI race, specifically focusing on the Middle East, where Saudi Arabia is pushing hard to become a global hub for intelligent computing.
Yeah, it's a very similar pattern structurally. IBM's chasing the compliant digital asset market. Saudi Arabia is pursuing sovereign-scale AI infrastructure. It's about building proprietary high-security capabilities. And we see Qualcomm now entering that AI data center race, challenging NVIDIA and AMD directly.
And their first big customer.
Their first anchor buyer is Saudi Arabia's Humane project, which is backed by the PIF, the Public Investment Fund.
Right. And the scale of this deal signals real commitment. Humane is planning to use 200 megawatts of Qualcomm's digital acceleration solutions, starting in 2026.
200 megawatts, it's massive. And it requires Qualcomm's latest chips, the A1200 and A1250, which aren't even fully out yet, set for commercial release in 26-27.
So this isn't just buying a few servers off the shelf. This is a national-level investment in foundational computing power for the future.
Absolutely. But building that kind of centralized infrastructure needs more than just chips and power. It needs people, specialized human capital.
Which brings us to talent acquisition.
Exactly. Look at the funding round for Skorios. Based in Riyadh, they just secured $3 million.
And Skorios focuses on?
They're scaling up an AI-powered platform specifically for remote tech talent, trying to bridge that huge global tech talent gap. Their platform connects companies with, they say, over 55,000 tech professionals across 80 countries, using AI to match skills and build remote teams quickly.
Okay, I see the connection. You can't run 200 megawatts of advanced AI hardware without the engineers and data scientists to actually operate it.
Precisely. Skorios looks like a strategic investment by the region, making sure the massive hardware ambition, the data centers, the chips, doesn't just end up as empty boxes because they can't find the talent. It's the human capital strategy that has to underpin that nation-state AI race.
Okay, so before we try to synthesize all these big trends, institutional control, AI infrastructure, geopolitical risks, we should probably close the book on one lingering piece of crypto history.
Yeah.
The Mt. Gox saga.
Ah, Mt. Gox, the ghost of crypto past.
Yeah, the exchange that handled, what, 70% of Bitcoin trades back in 2013 before it imploded in 2014?
Yeah.
The creditor repayment process just keeps dragging on.
It does. We just got news the deadline's been extended again, pushed back a full year to October 31st, 2026.
Why the delay this time?
It sounds mainly logistical, giving creditors who had maybe technical issues or incomplete paperwork the extra time needed to finally get their funds processed and received.
Okay, so the big question for the market. Will this final chapter, whenever it actually happens, create another wave of price instability? Is there a risk that this last chunk of Mt. Gox Bitcoin hits the market and triggers a sell-off?
You know, based on the analysis coming out, the impact is likely to be pretty negligible at this point.
Really? Why is that?
Well, the bulk of the repayments, the base payments, the early lump sum options, the intermediate ones, they've largely already happened over the last year or so. Whatever supply is left to be distributed in late 2026, it's expected to be relatively small compared to the daily trading volumes we see now.
Especially with institutions being the main players now.
Exactly. The whole narrative has shifted so dramatically. We're talking about institutional adoption, corporate treasuries, potential ETFs. The Mt. Gox distribution at this stage feels more like just a final administrative footnote, a kind of historical marker.
A stark reminder, maybe, of where Bitcoin started, that chaotic Wild West era versus where we are now, talking about Wall Street banks and regulated custody.
It's the perfect contrast, really, from the chaotic freedom of Mt. Gox to the controlled stability or perhaps rigidity of IBM's Haven.
Okay, so let's wrap up this deep dive by tying those threads together. We've got massive institutional money. You mentioned Citi's $4 trillion stablecoin forecast. We see global corporate treasuries starting to stack Bitcoin. It's all lining up, preparing to enter the digital asset space in a big way.
Huge potential inflows.
But they seem to be doing it only by building and using these controlled structures. Things like IBM's digital asset haven, other permission systems that fundamentally reject the very decentralized principles that arguably gave Bitcoin its value in the first place.
And this tension, this core conflict between institutional control and open freedom leads us to a really crucial question about hype cycles and longevity. Remember the NFT market?
Oh yeah, hard to forget that boom and bust.
Exactly. NFTs were pioneers in tokenization, built mostly on open blockchains. They promised revolutionary utility, digital ownership, but the volumes collapsed. The narrative kind of burned out over the past year. The applications just couldn't sustain the initial hype.
So now institutional focus is shifting.
Mm-hmm.
Heavy focus on tokenizing real-world assets, things like real estate, bonds, funds.
Right. And the argument we're hearing, reflected in things like IBM's product, is that this kind of tokenization only really works successfully within these highly compliant, permissioned frameworks. Control becomes the feature.
So the provocative thought to leave everyone with is this. Is this big institutional tokenization drive, the one being built on proprietary controlled systems and marketed as the future of finance? Is it just destined for a similar hype cycle? Will it eventually face its own narrative burnout, just like the NFT boom did?
Or does that absolute guarantee of compliance, the regulatory certainty that systems like IBM's are selling, does that fundamentally change the outcome? Does control grant these closed systems a stability, a longevity that the more open, decentralized market couldn't achieve, at least not yet?
Is control the killer feature this time, or is it ultimately the fatal flaw? That's the multi-trillion-dollar question, isn't it? Something for you to mull over, especially as you brace for whatever comes out of the FOMC meeting tomorrow.